So, most developed countries' central banks are raising rates, except for the Fed. The Fed is actually waiting for more data. We need to be sure about what to do and why are they not cutting. So, this is what we're going to be discussing today. It's a little more complicated than we think. So, first off, we need to see the coordinated movement from the G10 central bank policy rates. As you can see here, it makes pretty clear that we do have a very synchronized monetary system where every central bank, especially the UK, then you have Canada, the Eurozone, the ECB, Japan, Switzerland as well. They try to look to the side and see what everybody else is doing, and if they raise rates, I should also probably eventually raise rates as well. And then when we pivot, we should pivot together. Of course, there are some exceptions for that, like Japan, for example, trying to go the other way. But you see how sensitive it is. It's a whole other story for another video. But here you see clearly, since 2022, we have the pandemic, and all of a sudden we have a huge supply shock. But inflation, regardless of where it comes from, if it's a monetary phenomena or if it's just a price raise based on supply shocks, everything gets labeled as inflation, and uh, the only solution we have as central banks is raising rates. So let's control inflation, right? I'm saying it a little bit ironically because if you follow me already here, you know this is not really how it works. But this is the narrative, and all of a sudden, everybody just reaches that plateau, and every single bank on its level, and we should eventually pivot. And everybody awaits for the most important pivot of them all, which is the Fed and Jerome Powell, which actually happened. But then we just stopped. So if you see here the blue line, it's actually on the very top. It's one of the highest interest rates, which creates problems for the rest of the world because the United States is a central part of the whole real euro dollar system that gravitates around it. So every policy that is claimed to be domestic in the United States affects everybody else even more because they do not have the privilege of fiscal deficits like in the US, where we can create our own dollars. So they need to kind of juggle around and see how they can react to it. An interesting point here is this green line from Switzerland. So Switzerland was, if you can see here, before the pandemic, it was already using the negative interest rates, which was very exotic at the time. And then they eventually raised rates, but they were one of the fastest, if not the fastest, to pivot. So I would have a clear watch on Switzerland. This was my last video as well about zero interest rates coming back to the game on Switzerland, and this proves actually how narratives do not work. So everybody had, we have many narratives, right? After the pandemic, we have the China reopening. So China is going to make us all come back, right? Because the US is lagging a little bit more. And then the US is actually the hegemon, which is showing on numbers right now, even though mostly from fiscal deficits as well. But you see from the real economy that nobody is actually recovering at all. Since 2008, we do have a very different monetary system. What Jeff Snyder would claim as a silent depression or the forgot how to grow economy. So I like those analogies that he uses. So those expressions that he uses. So basically, you see most G10 countries in a way on a race towards the bottom, but not the United States. And this starts to create problems because right now we still have the narratives where we should go outside of the United States. It's the America last kind of trade that we see right now, and that could backfire a lot of strategies if we don't pay attention. And of course, it may create a lot of confusion on what to do, how to invest, how do I act on this kind of information. And since it's a very complicated monetary system, you can for sure get we dive deep into that on our Bitcoin intelligence report. As you can see on the link in the description below, you can see not only our latest article, which is amazing, and also our expert video analysis done by your own one and only Sina. and we pour hours into this. So this is a very nice and complete way with many charts, on-chain analysis for Bitcoin, but also my own contribution as well on monetary mechanics, so you understand exactly how this drives market and how this will affect your investments over time. So how to separate narratives in the short term for your strategy on the long term. And again, you can see everything into the link on the description below. Make sure to use the promo code as well for 5% off, because why not, right? So back to the video. So the Fed actually has a complicated task, because you need to convince everyone that monetary policy by the Fed works at the same time where you have a regime where fiscal is what dominates, especially in the United States. This is why higher interest rates did not control inflation at all. It is because it's not how it works. You're actually doing the opposite. You're stimulating inside the United States, but you are actually creating some tightening outside of the United States. And this creates some kind of a tension longer term, because the euro dollar system, the dollars outside of the United States, they need funding. So you need to source them over time to be able to pay for your debt, for your existing debt. So that's why we do repo. That's why I talk so much about this concept here. And this reflects on the yield curve that I just showed. So this is currently, that's the most updated yield curve of the United States. But what I would like to bring to your attention here is that this curve tells a lot of stuff at the same time, a lot of things at the same time. So you can clearly see that we have an uninversion. So the curve was inverted, and then on the longer end of the curve, it got to a steeper slope. So it got uninverted, which could mean that we expect for some growth, but not really, because those rates are coming down, especially after the whole narrative of the hot potato US bonds is actually over, because we're talking way more about the war now. It seems to be on everybody's head. But this short end of the curve, this U-shaped part here where we talk about T-bills, which is the pristine collateral, that shows a lot of pressure, that shows a lot of demand, because it's inverse, it's an invert proportion. So the more demand we have, the less interest rates you need to pay, so higher prices. And this was the focus from the United States Treasury at Janet Yellen, and it's exactly the same thing so far. It's changing a little bit, but so far by Scott Bessent as well, where they're going to be focusing a lot on providing that pristine collateral. That is exactly what the market needs in order to generate credit, in order to generate liquidity, in order to leverage themselves. And this is the way the United States truly stimulates the economy, and not the Fed. This is why we create so many smoke screens on how to interpret things. Of course, we need to understand that the market, short term, if you're a tactical trader, if you're a day trader, you should still live, so to speak, in the matrix, in the narrative, because it's traded that way. Algorithms do that, but the fundamentals never change for the long term, and it's like the law of gravity, so to speak, if you want to be more realistic, and they guide the whole liquidity, and it has a lot of a lagging effect as well on where is it going to reflect on liquidity that will drive up the S&P 500, but especially as you are interested here in Bitcoin as well. So this is going to be very interesting, because this here, if the Fed just keeps it high that way, or how long is that going to last, right? So if everybody else it has a race to the bottom, and the US just stays put, that's going to create more and more pressure, making U.S. bonds extremely attractive. If you understand that the real economy is not doing that great, so you're going to be expecting less inflation, less growth, which is already one reason for you to buy the longer end of the curve, which is currently happening despite the narratives. But at the same time, it will start the dollar milkshake effect as well, going capital coming back to the United States. And this can create a lot of problems, especially to EMs, to emerging markets like Brazil, like Indonesia, like India, like Russia. China, to a certain extent, is a complicated subject. But yes, this can start a reversal on the DXY. So I would not be surprised if the DXY goes to 80 or lower 80s, but it always swings back if you understand that the whole world needs dollars. They need to be served. And that is happening right now. And interests are going to need to be paid for the future. So I'll keep, let's keep an eye on it. But also, Switzerland is a great indicator on what can happen in the future, as we have as Trump would say, the too late Powell. So let's see how that goes on the next steps. Of course, I hope it was useful to you, and see you in the next video.